have right off the bat, you can go ahead and ask, and I can kind of see what you guys might want to go over. We can sort of just generally run through the concept and the method of trading volume with technical analysis. Is there anything specifically? What is a pip? A good place to start is, making sure you understand the supply and demand balance concept and why it is that lower prices may attract buyers, higher prices may attract sellers, which at first sounds backwards. Patterns at support resistance you wait for, and time frames. By patterns, you mean, because I'm not big on patterns, but you mean the simple, like, how to read the reaction kind of stuff? Reversals, okay. And, okay, right. And time frames, you mean just how to use the different time frames? Which is basically 1 hour and 5 minutes after the overall analysis is done. What time frame you look at support resistance? Okay. Well, basically with support resistance, I mean, that's the shortest answer. You start with the larger time frames, and you just mark up some obvious levels that may be tested, and just go with the really obvious, most recent support resistance and some fibs that may be in play at the moment. So it's not a whole bunch of stuff, but typically 4 hour and daily. Once you get to the 1 hour, you may notice another one. There's typically like 3 really that we're dealing with, and maybe 1 fib or 2. But as far as the time frame thing, it's like I say, different versions of the same thing, just looking at more or less detail. I just spilled my grapes. So you're looking at more or less detail at really the same thing, right, with time frames. So it shouldn't be that different as far as support resistance. You just may notice a couple of more as you go down in time frames. Okay. So we'll cover that stuff that was mentioned. But a good place to start, yes, question. Okay. Definitely get to that, yeah. Test for supply, test, yeah. Okay, cool. All right, good. So the concept that must be understood is the whole lower prices may attract buyers, higher prices may attract sellers. This is like a whole foundation of it. So, that's the sort of thing, to me, just like everybody else, sounded backwards at first. And, the way it's explained in VSA is strength is first shown, right, in down moves. And weaknesses appears, or it's first shown in up moves. And of course, it sounds backwards. If price is moving down, how do we know that there's strength coming in? It makes no sense at first, right? I don't think that makes sense to anybody when they first hear it. So that's got to be understood. All right. So if you're looking to buy and prices go down, this is how smart money thinks, and this is the proper way to buy and sell and work any market, really. We're talking about selling low, buying high. Buying low, selling high. And the way you would, if you're looking to buy something and price is going down, it may attract you to buy. So that should already start clarifying, giving some logic If something goes on sale, more people are going to buy it. If something is going up in value, it's going to attract people to sell it. So this applies to any market, anything, right? So that's something everybody has to understand. That's why, if we're looking at a resistance being broken, let's say it's the previous day's high, and it's going to new high ground. First question pops into my mind is it going to attract sellers at the higher price? Is the activity going to increase and the higher prices get rejected? Or the result of that high activity not continuing up in price? So that's the first thing we always have to keep in mind. And we're talking about how smart money first positions for a move. So again, if there's a downtrend and they are, looking to reverse that trend, it's the lower prices that are going to attract them to buy. And it's not just, all at once they just start buying and mark it up. They'll build a position at lower prices before they even want the uptrend to begin, so they can build a large position over time at low prices, which would be accumulation. So hopefully that's making sense to everybody. What about the trend trades? Who start selling when the trend is down, or vice versa? Well, the thing is that smart money, you could categorize it basically into two categories. I can't talk today. Good day for a lesson. Which is when they're pre-positioning for a move, is what I'm talking about. Buying into down moves, selling into up moves is the first way. But the second way that they operate is causing a trend intentionally. So the first one is more hidden. And there's a switch over from way one to way two, and it's like night and day. And there's a big difference in the way that they actually enter the market. So for example, I'll start drawing here. So prices coming down, and the lower prices are attracting high volume. And that high volume is not causing the down move to speed up. It's causing it to slow down, go sideways, give a bounce. Then we know for a fact there's buying coming in. That's a fact. Because if the activity was more selling, it should speed up. And that can happen. And we would call that aggressive selling. Maybe some buying is in there as well, but it would be obviously very aggressive selling if the result of high volume is it continues. So just to make sure you get that concept, there's a certain amount of activity in the market on average. That activity increases, and as a result, it doesn't go faster. It stops. It goes sideways. It gets a little bounce. So you know there's buying coming in. It's like an opposite force. So prices moving down, the market gets more active, but the down move does not continue as a result. And basically, that stuff can be narrowed down to two candle patterns. So, of course, we could call that stopping volume as, one candle comes down, attempt to draw a candle. And then the second one is, that's a bad idea. And then the second one is, so basically a two candle pattern. The second one's bullish, or it does not close below the low of the first candle. That's technically how you confirm strength. So this one came down, has high volume, maybe there's a pin right there. And as long as, to give you that technical definition so you know how to confirm it, the reaction, the two candle pattern, if we're talking about stopping volume, high volume off a low price, if it closes below the low here and continues down, it closes below that low, call it aggressive selling. It's not buying. The market became more active and continued down. Again, it may represent some buying that came in because of all the activity, but still more selling than buying, which is, not a time that you would want to look to buy yet. So we need that reaction. And ideally, you get a bullish reaction, showing that there is good active buying off of that activity. So that would be your sign of strength. So that's the visual of, sloppy as it is, but you get the point. Lower prices attracting buyers and getting that two candle pattern basically as a confirmation. So this is, we're talking about here accumulation. So again, they're buying into low prices, and it doesn't mean that they're immediately looking for a price to trend upwards. So we're in the first way that they're entering, which is pre-positioning. So, of course, very often you'll get, for example, a double bottom. And if you see that, and you're testing that lower area, particularly where it was rejected, if you're looking at where the pin is, particularly, but generally at support, if it's testing and getting into these lower prices again, what I particularly like to see is continued, if I'm expecting a reversal, is continued activity in these lower price areas to show that they're building up long positions. So they're continuing to buy into down moves. So when you see that over time, you know that they're really committing and that there is a plan to mark price up. Now, generally, we're talking about a downtrend and looking to buy off something like that. We want to see basically what's called climactic volume, right, or ultra high volume. Ideally, it's the highest volume of the day. You need good reason to go against the trend. So once that occurs, we look for a lack of supply and all that, which we'll get to. We'll get into the details of the entry. So this we would call accumulation because we're seeing sustained higher volume into the lower prices. So again, if it was something like this, as we saw strength come in, test lower prices, and we didn't really see much activity, it's more likely to continue. Now, in traditional VSA, you may have heard that you can look for a no supply or a low volume test here. That's something I found to be inconsistent. So I want to see that there's sustained activity and rejections if I'm expecting a move to reverse. And I see that they're really committing to building those positions. So now, if we're talking about going against the trend, we need that ultra high volume. If we're going with the trend, let's say this is just a pullback on generally what's been an uptrend, right? And we have a pullback. Let's say this is like a 1 hour chart. Maybe this is a fib pullback. I tend to be more aggressive on that, and we don't need the ultra high. We need an increase over the recent range. Again, if we're going with the trend. So it's really when you're going against the trend that you really want that ultra high stuff and give it more time. The aggressive entries, tend to be more going with the trend on the pullbacks. If we're talking about going with the trend, again, this would be called reaccumulation rather than just accumulation. Accumulation is basically, to reverse the downtrend. So if we're in an uptrend and we're pulling back, we're seeing the buying. It's reaccumulation. So that's what it's called. Reaccumulation tends to be shorter. It's not going to last typically for days like accumulation or distribution can. They're just typically a shorter period of time. So, which makes sense. They're adding to their long positions on a retracement. They're not completely dumping their positions and changing trend. So the volume isn't as high, and it tends to not last as long. You can be a little more aggressive with it. So in this case, we're looking at reaccumulation on a pullback during an uptrend. That's probably the most common trade, or at least one of the most common. Very simply, again, that could be a fib at some technical levels. So let's just kind of run through an overview, and then we can get into like entries once we understand things a little better. Automatic rally. That's always good to cover nice and early and make sure we're working around that too. So if we see strength here, we'll get into entries. Again, this is just to understand things. If we see buying coming in, let's say on a retracement during an uptrend, reaccumulation, the first level of resistance, and in generally resistance levels that form, again, this could be a 1 hour chart. It's a good home base for reading volume, getting the overview. Any level of resistance that sets up, particularly the first one, which is called the automatic rally. So that by definition, the automatic rally is the first level of resistance after strength. So, and of course, you could have that in reverse automatic support off of weakness. And if you're thinking about why that is important, why it occurs, why we pay attention to it, is obviously price, for the most part, is zigzagging, right? And we have these little support resistances. So, again, the idea that lower prices attract buyers, higher prices attract sellers. So, for example, this would be considered a very mixed condition if we saw this. That high volume is off of this resistance that's set up. So first we have buyers, which stop the down move and create a support. And as price moves up and creates the first level of resistance after that, in this case, for example, I drew high volume on there as well, showing that higher prices, because price was moving up, right, attracted a lot of activity, and as a result, moved down. So that would show you there's selling in large amounts there as well. This is not a good situation to trade. If this is a big enough range, you can maybe look to trade the range. But we're talking about, looking for a long position here on a pullback. So something like that would not be a good sign, right? So obviously, we already know what causes support resistance. Prices moving up, and eventually there's more selling. So if that selling sets up on high volume, we know it's actual, smart money activity coming in. And so in that case, this would not be a great situation to look to buy. When it comes to the balance of supply and demand, you need an imbalance. So if we're talking about buying, we don't just need buyers, we need lack of sellers. That's the proper way to trade VSA. It's looking for the imbalance. So you need not just one, but lack of the other. So if I'm looking to buy and price is moving up, that initial reaction to strength, I get to see as the price is moving up, is it attracting sellers or is it not? And a resistance may form, so that is what we don't want to see. That would tell us that active buying came in, then active selling, and a sort of a mixed condition. And we have a balance in supply and demand, more of a balance, which tends to create ranges and not good trending moves. We need imbalances. So ideally, of course, we have lower volume there. So a very familiar pattern, even if it doesn't double bottom, which it does often, that first level of resistance after strength, looking at that volume, even if it just pulls back a bit. So what causes a resistance level if there isn't an increase in selling? Good question, right? The first way made a lot of sense. All right, there was more selling as price went up. But what would cause that? And let me draw that in line with a previous support, because that's very often how it happens. So that first level of resistance is this previous support. So what caused price to come down without an increase in activity? Well, if smart money is buying into down moves, but they're not selling into up moves, what caused that? Well, they're going to test for sellers, and they're going to do that at obvious places. This is probably the most common, the previous support term resistance. I mean, this could even be on a 5-minute chart. This is just a very common pattern. But if we're looking at a 1-hour overview, common stuff here. It could also be a daily pivot. You'll notice over time they just use the most obvious levels to test. So if you're a smart money buyer, what's your concern? The amount of selling that's still active. You want that to dry up. You want a lack of selling so that you can mark up price, go into that second way of entering the market after accumulation and mark it up. So that's really the only concern, right? And it's sort of a funny relationship, because as a buyer, you need sellers to give you low prices. So, for example, let's say we had a slight increase in volume, but nothing compared to the amount of buying that went on. But a slight increase here as this resistance set up. That's showing that there's some active selling. As far as if you're a smart money buyer, that communicates to you that A, it's not time to mark up price yet because you're going to have a problem with sellers coming in. And B, you can get lower prices again to continue to build up a position. Remember, smart money is trading very large amounts. They want active selling when they're buying in the pre-positioning, or else they're just going to mark it up and not get a good price. They won't be able to buy so low, right? But to answer the question, what causes this to come down without volume is the lack of buying, so that they test for sellers. And they'll, again, do it at an obvious place that's going to tend to bring sell activity, like a previous support term resistance, or coming up to a pivot, or maybe that's a fib from this high to low. Just the tools that we use. There's not that many. 50 EMA could be coming through there. It could be a few things. It's almost never that this sets up just in a random spot. Okay. So the test for sellers occurs. So if you're a smart money buyer, you're going to pause your buy activity and allow, see what's going to happen there. So that's why you'll get lower volume resistance after strength. And that's the kind of thing we're looking for. So smart money's buying into the down move. It's creating a bounce. But as it comes up to a level, they're going to test for sellers. They're going to pause their buying activity and allow the test for sellers. Again, high volume would communicate to them this is still a lot of selling. Lower volumes would say, okay, there's not a lot of selling. And that's the kind of condition that we're looking for. So we understand why that resistance set up, even though there wasn't a lot of volume. The buyers paused their activity. The sellers were more active, but generally not very active. So to finish up, to show the switch from one way to the other, once you pass the automatic rally, so we see here that they've accumulated. This situation is a healthy bullish situation now. They've positioned long because we know the lower price and the reaction and the high volume. And we don't see the up move and the resistance in between this double bottom bringing a lot of sellers. So this is a good imbalance of supply and demand, right? Lots of demand, little supply. So once we move up past automatic rally, which probably 90% of the time will show up, things rarely move in a straight line. They do that test. So once you pass that, and again, this is like a fractal pattern. This could be on a 1 hour overview, and you would look at this and say, price looks like it's starting its markup from accumulation. Or you can have your strength and stuff established on a 1 hour chart where you're looking to buy, and this could be on a 5 minute, giving you a detailed look that they're starting to mark up price. So it's a fractal pattern. Let's learn that pattern. It doesn't have to be a double bottom necessarily, but if it is, you get to really see that sustained buying. And I always prefer a double bottom or a double top to a single. Even if I get in early, I'm looking to put my stop so I can survive a double bottom or double top in case that happens, since it happens so often. And maybe, of course, a fake breakout. That never hurts. So once you pass the automatic rally, we have a good, healthy situation here. We're seeing that the sell activity at this level is very low, so we would not expect high volume there. Again, we don't want higher prices to attract high volume. Now, a little increase is typical if we're switching over from accumulation or reaccumulation into markup again. You may get a little increase in volume, but really what you're looking at is you don't want these higher prices to attract lots of volume and anything comparable to the buying. So, for example, something like that would be a warning that the markup may fail because the higher prices into new higher ground attracted a lot of activity, right? And the reaction was bearish. So something like that would tell me that most likely the markup is going to fail, which happens. Now, if we're looking for entries at the right points, in the right way, we're not going to get caught in a bad situation. So we have to be aware that once they pass this level, we need to see what's going to happen there. So we're either positioning lower or waiting for this to give us some information. So if this is a 1 hour chart, ideally you're looking to buy in these areas, particularly if you have a second bottom and another sign of strength on a 1 hour chart. We go to smaller time frames and look to buy in these areas. So the bottom of accumulation is ideally where you want to get in, where they're getting in. And you can have, strength and a no supply, and maybe even this pattern shown on a 5-minute chart if this is your 1 hour. Sorry, 1 second. 1 second. Okay. If anyone has questions, just jump in. No problem. Don't worry about interrupting. Okay. So let's make this healthy. So slight increase is acceptable. No increase. Lower volume. We just don't want to see higher volume into high ground, right? That's telling us higher prices are still attracting sellers. So in this case, we have a good situation that still looks bullish. So hopefully that concept now you get the higher and lower prices attracting activity or not. AJ seems in 5-minute time frame the reverse of what you mean now. That very often happens during a lesson, is that people spot it happening on the chart. Today is pretty crazy, but let's see. Sure, we can use that as an example. I can actually use that to point something out. So yeah, let's look at AJ real quick. Now, first of all, the overview here is not telling us to look for a short. So we're assuming that it is, so just for the sake of this example. But this high volume, we would look for that second candle reaction, right? So we're talking about counter trend, and we would need ultra high volume. That is there if we were looking to go against the trend here. So the ultra high volume is there. It's the highest volume of the week. So it's a perfectly good way. That is the way to end the trend. But the second candle, which still has 30 minutes left, would have to, at the least, we cannot close above that high. And really, ideally, you get a bearish reaction. So you get some good selling as a reaction there. So just to point that out. Okay. So it's not yet confirmed to go short. But let's use this example because we see the high volumes. So, and again, it's news, whatever, but it's still something to show here. If you notice, the really high volume stuff, right, happened on these two candles. That's where it started. And what was the reaction to that? It continued up, and the volume was a bit lower. Now, this is a little unconventional with the way that things are moving today, but the general idea that if you're seeing potentially what's weakness, there's not yet a setup, but you're seeing weakness come in, price moves up, and the volume is lower at the higher price areas. That is not ideally what you want to see. The ideal situation, whether you're talking about 1 hour chart, 5-minute chart, and really for a setup you want to see it on both time frames, is that the higher price would have the highest volume. Because again, as price is moving up, the more sellers become attracted. Now volume, we could still say is high here, and this is a little unconventional, but the way things are right now. But generally, for example, if these two were a bit lower, and then the higher volume was here, and then again, we can now look, if we were looking short with the larger time frames, which we're not, in this case, again, double tops, double bottoms, right? So the question here is, if this was properly the highest volume spot here, the question would be, is there going to be sustained selling here? And what we would expect is, again, higher volumes in this area, which we're not seeing. So if we were looking to reverse this, this is not a proper situation right here. So you would want to see the higher volumes, at these 2 points. Typically on a double top and double bottom, the first one is higher volume. The second one is just a little increase over the recent range. So this one would look something like that. Which would be, the proper situation to continue to look for the short. So I think we understand that. It looks like this is going to actually happen because that's why this bar clock is so handy, right? It's already the same level as the previous volumes, previous few, but there's still almost 2 minutes left. So by the time that candle closes, right, it's probably going to be up there somewhere. And so that is likely to cause at least a retracement, and it is communicating sustained selling at this level now, right? There's the 1 minute, just to see it in detail. So we see the increase in activity at the high price. We see a bearish reaction. Again, this was like excessive activity for a little while. Normally, you're not going to see high volumes for so long. It's, the type of day we're dealing with, which is rare. So more typically, if this was a proper reversal situation, again, this wouldn't be just high, high, high all through that. That's not very typical. And again, higher volumes here. So with that situation to the left, if it was like that, this is ideal that you would again see that is the high price in this little area. It's slightly higher and the high volume and the bearish reaction. So now we have sustained selling. So again, those double tops, double bottoms are always helpful when you see that increase on the second test. So we can continue to use this for a second. Now let's say this sets up a little support. Now again, this is a fractal pattern. It could be on a 1 hour chart for your overview. This is a 1 minute. Let me go to the 5 minute. Nah, I'll use a 1 minute for the sake of example because it is happening here. So when I say fractal, yeah, for real. 50 EMA, 1 minute chart. I normally don't do this 1 minute chart, but that's what's showing the pattern right now because it's fractal. So there it is. 50 EMA and Fib, right? Obvious place to test for buyers now. So that's what I mean. So if we were looking for a short here, which we're not, if the overall situation was telling us look for a short, for example, this could be an uptrend with climactic volume on a 1 hour into the high ground, then we would say now that we're just finding our automatic support, automatic rally in reverse, right? So here it is in real time. And the test for buyers. Now, did this set up on high volume off of that support? No. And we'd look for the low volume test. And why does volume drop down here? Because smart money is positioning short into up moves. Again, hypothetical here with the news stuff today, but smart money positioning short into up moves. And as you come to an obvious place that's going to tend to attract buyers, Fib, 50 EMA, they're going to pause their activity. They're going to completely stop because they're not buying, they're selling. So they can see the amount of buying still left. Now, very often you can get very low volume there and no demand, right? So you see the lack of buying that would come in. So is that all making sense? The test, the pre-positioning, and then the test, we're good on that? So smart money can take this information, and generally, if we have low volume here and a very low volume up move, it communicates to them what? There's not a lot of buying, that you're not likely to get any those good prices anymore. There's a real lack of buying. And particularly once you see this level broken, that they would now have the confidence to start marking it down. and if it gets broken without buyers coming in, that they're likely to go now start marking it down. That second way of entering, intentionally pushing price down when they enter rather than staying hidden and trying to sell high. So even on a 1 minute chart, you get that little pattern test for buyers. So any questions on that? And I want to now go to, now that we understand the concept of how to read the high volume, how smart money works, how they position, let's go to a basic analysis of a 1 hour chart. Good. Basic analysis of a 1 hour chart for our direction using volume. So, as you've seen, once I, what am I doing? New. Once I mark up my levels on, daily chart, 4 hour chart, just obvious support resistance, any fibs or a trend line or whatever may be there. Nothing too complicated. Maybe a very simple wave count. Once those levels are marked, next thing is go to the 1 hour chart, right? Look at the recent high volumes and see what they tell you. So I'll give a few scenarios that will pretty much explain what this stuff tells you. So this would be our first look at a 1 hour chart. Let's say we're in an uptrend. We've established from larger time frames, maybe, doesn't even matter. So then we go to the 1 hour chart and look at our recent high volumes to see what they mean. So if we're in an uptrend, the question would be, is this a healthy uptrend that we're continuing to expect to go up and we're going to look to buy? Or is this uptrend hitting sellers, hitting supply at higher prices? And A, we're not going to look to buy as long as weakness is coming in. And B, is it telling us to go short and against the trend? And particularly if we're going against the trend, it has to be high volume selling coming in. So that's the question. Do we go with this trend or are we expect it to reverse? That's if we have trending conditions. Ranging conditions, maybe we'll get to that. So, but very simply, the highs and lows, higher highs, higher lows. There's no magic to it. That's what tells us there's a trend. So in this case, for example, if we look at our recent high volume on the 1 hour chart, I'll draw an ideal situation. This is what you would want to see, right? If you were looking for, this is like the perfect situation. Let's make that. If you were looking for longs. Okay, I just didn't leave enough room for my volume bars now. But really we're looking at the trend here. So the lower prices are continuing to attract buyers. Again, these are reaccumulation points. You can look at Eurodollar yesterday and see a double bottom at fib on high volume. And, today, whatever with the news, but you can see that stuff. So that's an example, just yesterday. So this would be a situation if I go to my 1 hour chart that's very clearly telling me that I'm still looking to buy. Now, particularly these high price points, particularly here, we can't see higher volumes. We want to see the higher volumes on the buying into the down moves, right? This should be making perfect logical sense. The lower prices are attracting them to reaccumulate. Smart money is still long, and we don't see profit taking. We don't see weakness coming in. So this is an environment where I would look to buy. Typically, if price is high like this, I'm looking to buy in retracements. Levels of confluence where price pulls back and again find some buying. And I would expect another leg up. So those pullback opportunities. And again, those two candle patterns can happen. 1 hour, high volume, bullish reaction, And then we go to our smaller time frames, look for our entries. So, most very simply, during an uptrend, looking to get the pullbacks when we see reaccumulation. And making sure that the higher prices are not showing high volume weakness. So So this would be a good, healthy situation to continue to look to buy. But, really, what do we have to worry about in this case? Because it looks so ideal. Is, of course, the higher prices attracting sellers. So we don't see them here, but, for example, this is why I don't take breakout trades. Let's say I have a setup here now to go long. So it's late in the trend. We just saw some buying coming in. And we're coming up to a resistance. Late in the trend and coming up to a resistance. This is not where I want to look to buy. Because, okay, it may test the resistance most likely, but, we're talking about getting some decent targets, trying to get a swing of this trend. And, beyond here, we're into new ground. And that's always the danger. That's always where you may run into sellers, when you go into new high ground. That's why we like the pullbacks. Why do we like to buy on a pullback, even if we're seeing a trend that we expect to continue? Because we've seen the price area that we're buying into. So if you're buying here off of stopping volume, 1 hour down, bullish reaction, and you're looking to enter, you've already seen this price area and that there's not a lot of selling. So the chance of a lot of selling coming in here is not very high, right? So, of course, if there was, that would be very dangerous. It may not even make it up there. We know that there's profit taking and selling coming in. So, point being, we saw these higher prices. They didn't attract a lot of selling, and we saw more buying. It's very, very likely to test that point and maybe go beyond, but we don't know what's up there. So, again, it's that same old principle. Higher prices may attract sellers. If the volume is high and the higher prices get rejected off of that activity, then we see our sellers. So we don't know what's lurking up there. So going long late in a trend without waiting for a proper pullback is very dangerous. So breakout late in a trend, bad idea. Even if the volume situation is good. There are rare times you could do it, but it's not really as high probability. It's not really conservative in the proper way that I trade. So I won't even get into that. Okay. Pretty simple, right? No questions? So it's the 1 hour chart, high volume, recent high volume points. What do they mean? What do they tell us? And very simply, where did that volume occur? And what was the reaction? So again, 1 hour chart. Now, really don't skip this stuff. When you see stuff looking good, make sure you're not seeing high volume at higher prices showing weakness as well. Because people sometimes kind of just ignore that and say, okay, we have an uptrend, price is pulling back, I'm going to look to buy. But if this area had high volume, that's not a situation you want to get in. So we want to continue to see that healthy situation. Okay. So again, what would cause us to go against the trend? We want ultra high volume into new high ground. So this tells us now something changed, really changed. Profit taking, selling, it works together. Because why does smart money sell their position? Why would they get out? They have information, access to information we don't. They can know who's doing what. So if smart money is long and some large selling starts to come in, that's going to be a warning sign to them to get out of the positions. So it works together. So high volume into new high ground, bearish reaction. And that tells us now we no longer would look to buy. There's no way you want to buy in this situation now. And you want to look for the short. So, be sure that high volume, if we're talking about going counter trend now, is actually in the high price area. Now, if that higher volume was here and continued up as a result, we would say that it would be aggressive buying, right? We're talking about where that high volume occurs. So if it's here, for example, the result of that high volume was higher prices. Very simple. It wasn't a high price getting rejected on high volume. It was high volume leading to higher prices. So very simply, we call it aggressive buying. So it's effort versus result is the principle. So the market became very active, a lot of effort, and the result is higher prices. We know that it's buying. Or at least it's more buying than selling. So again, if we're looking to reverse a trend, we want nice high volume at a high price. So now you understand why we very often get double tops and double bottoms. Because if you're getting to that point where the higher prices are attracting sellers, typically a double top, you're going to have high volume on the first top, and it's going to continue anyway, or an increase in volume on the first top. It's going to continue to new high ground, and then again, if they're selling into high prices here and price goes up, you would expect selling again to come in. It's the higher prices that are attracting them to sell. So you could very often end up with a little resistance, some higher volume because of the selling attracted, and slightly above that. So again, the higher price goes, the more supply will be attracted. Just again, think of a real life example. If suddenly the housing market has a boom and prices are suddenly high, it's going to attract people to sell. Would it attract you to sell your house if prices are high, or would it attract you to go buy a house? So the higher it is, the more likely it's going to continue to attract sellers at that point. So that's why you can very often end up with a double top, fake breakout. And it's always nice to see that if we're talking about trend reversals. It's not you need it every time, but it happens a lot, and it does help the probability. Okay, so we should understand now what a healthy trend looks like, and the most common place I look to get in with it, and what the volume needs to look like at the high and low prices, and then the proper situation to no longer look to buy and now look to sell, to see nice high volume at a high price. That changes everything. And again, this would be called accumulation, this would be called reaccumulation, and then now we have distribution. Just think of them, they're distributing, they're selling off. These are sort of old leftover terms that we just use. All right, let's get into any questions here. Because it's really important that you do this 1 hour analysis and know which direction you're trading in. No questions? That's a good thing, right? Okay. All right, so what we'll get into now is the entries. Now, we didn't cover the technical analysis stuff, but we're not going to do everything. But, you have stuff that's not that complicated. Previous resistance becomes support. We're looking at fib zone pullbacks. I only use the 50 to 618, no other levels. That's very typically where these pullbacks occur and bounce. Now, I drew this really clean, but when things are messy, sloppy, you're not sure what the trend is, it's kind of moved down, but then it's moved up, and this and that, you can still apply these same things. Are the higher prices attracting sellers or not? Where's the high volume? What does it show that they're doing? All right, let's get into entries now. So if we're looking to short here, because we've seen enough volume to tell us we want to go against this trend, we expect it to reverse. So let's say we're here, and we go to a 5-minute chart because we had a fake breakout, high prices, brought high volume. And just to mention while we're on the fake breakout, very simply, it does need to come back into range. From a 1 hour point of view, I need to see price come back into range. I think we just saw yesterday this go on. I think it was the pound yen. It did this. And that was telling me no. It looks like it's not happening as far as a reversal. That's a break test continuation pattern. That's previous resistance acting as support. That was yesterday, pound yen. So I think the smaller time frame showed high volume coming in, but it continued. But there was no close above this. It acted as support. So much, much higher probability once you close down there on a 1 hour chart. And again, we're being more patient because we're talking about counter trend. So seeing that come back down greatly increases the chances. And of course, that really confirms the fake breakout pattern. You need that close back below that resistance. So let's say we're here. Now that I just cleared that up with the double tops, double bottoms. So let's say we're here, and now we're looking to short. We have it all confirmed. We have high, ultra high weakness, the bearish reaction. So let's look at that second top on a 5-minute chart, something like this. The resistance. There's the first top. And there's our fake breakout. So if we go to the 5-minute chart now, what do we need to see? Same thing. First of all, high volume at the high price. Typically it's going to look like that, sort of increasing, and you're going to want to see that. And again, with those time frames, right, it's just more detailed view of exactly the same thing. So if we saw high volume on a 1 hour chart on this fake breakout, we want to make sure that that high volume is, in fact, off the high price area. That is that principle that it's the higher prices that attracted the activity and the rejection. Because you can see high volume on a 1 hour chart, and this is why, simply the 1 hour and 5 minute will do it. If you want to use the 15-minute, 30-minute, you can. You can take no supply, no demand. You can look for strength and weakness. But to simplify it, if I had to just use those 2 time frames to look for my entries and read volume, I would be okay with it. So you could really keep it that simple. So the 1 hour chart told us, and we want to make sure that the 5-minute chart confirms that situation, high volume at the high price. So we could see high volume, on that bullish candle on a 1 hour chart, but when we go to the 5-minute, it's this. Right? And what does that tell us? It's not a proper setup. In this case, again, the same principle, effort versus result. The high volume, let's say, was here. What was the result of that high volume? Moved up. Now, higher prices. Did that attract buying? Is that? No, right? It's lower. So it could look great on a 1 hour chart, but I go to a 5-minute chart and see that. No good. I would look for proper confirmation on a smaller time frame of weakness coming into the up moves. So again, very simply, you could just use those 2 time frames and make sure that they agree. So the high volume, I'll draw it properly, should be off the high price. That doesn't mean it has to be absolutely something like that. I mean, that does occur. And that's the ideal situation. But, you can have high volume, maybe a couple of candles before, as long as it's high off the high price. That is key. This one could be high. This one could be slightly lower, but it's still high compared to the day. That's fine, right? But you just don't want to start seeing this stuff starting to happen at the higher price, lower volumes. So that tells us that the higher prices are continuing to attract those sellers. Okay, now let's get into, now that we have a proper situation, go through the method of analyzing and looking for the entry opportunities on the smaller time frame here. So 5-minute chart, we have our good volume situation. Our uptrend has climactic volumes telling us we can go short. And we have a little fake breakout pattern, which is nice. So the first opportunity to enter, very simply, of course, we're talking about a fake break. It's got to be below that level. The first opportunity would be very simply no demand, right? And again, I'd rather see that in a predictable spot than just some random place. So I don't think in traditional VSA they really talk about where they're going to test for buyers and sellers and where ideally you could expect it and is the best place to see it. So previous resistance turns support. It doesn't have to be, but again, you'll find if you just use these tools, 90% of the time you're going to be able to predict, in this case, where they're going to test for buyers. And people that have been here a while see that it's okay. This is probably going to be the automatic support, and then we get a little bounce. It could be again the 50 EMA coming up through there. There's usually a couple of things. It could even be the 14 EMA. That's why I use those two. It could be a fib retracement of this low to high, very simply. So you'll see that you'll nail that a lot of times. So here I have a test for buyers. Because again, weakness is great, but we need a lack of buying. So let's say we get very simply a no demand. So price, and somebody asked for the technical definition of a no demand, so I'll give you that. Of course, we're only looking for a no demand once we see recent weakness in the background, this stuff. So then we see the test for buyers, and that's where we can find our no demand, right? So logically now we get why. It's a lack of buying, and the selling is very active. So we have that imbalance of supply and demand, more selling, less buying. So the technical definition of a no demand is volume lower than previous two on an up candle. So let's just say there's a bullish candle right there, and the volume is there. So that's potential no demand. I can actually draw it in, give you that visual. That's a green candle, moved up. And there's our volume on it. So that's now a potential no demand because we have weakness in the background. We've done our analysis. We have fresh selling. And now we have our first test of buyers. Could be an obvious place. Doesn't have to be. Usually is. So volume lower than previous two, up candle. Now we have what we call a potential no demand. It has to confirm. So potential no demand. So price has to move below the low of the no demand candle to confirm. So technically VSA, there's your short entry. There's the first opportunity because very simply at weakness, no demand, and no demand confirmation. So that would be your first very simple, typically the first entry that pops up most of the time. Very simply no demand. So again, traditionally, once price moves below the low of the no demand candle, you can enter immediately. What I like to do, as most of you know, is give it some time. Unless it's just sort of moving very aggressively, but I like to wait for the close. Because what can happen is, and really in VSA they're telling you to do this, which to me is a little, I guess I get it, but it's just so much safer to give it a second. To literally enter right away. As soon as price comes out, you can set the order right there, 1 or 2 pips below the low of that candle, and if price comes down, you're in the trade. So what if it comes down and pops back up, and now you're in the trade? So I want to see that the lower prices can be accepted. We still have a general rule that lower prices can attract buyers. So if we can see a no demand and then lower prices sustain for a little bit on the second candle, that it's really holding down there and getting towards the close, and the bar clock is helpful to see how much time I have left on the candle right there. And if I could wait for it to close, or at least give it half the candle, or give it some time to see that the level below the no demand can be sustained and doesn't pop up, it's just much safer to deal with it that way than get in right away. Because it could pop up and you're like, damn, I could have waited and saw the reaction to that price. Okay, Ryan, cool. You too. So very simply, there you go. Weakness, no demand, entry. Okay? So it does get a little more, there's a little more to it, but that's the most simple. So again, dealing with our automatic support and all that stuff here. So let's say we don't get a no demand, or let's say we did, but what I want to point out here is this. From a 1 hour point of view, right, we need 2 hours because we're talking about going against the trend. That's why we have to do it this way. Again, you could be more aggressive, not waiting for 1 hour closes to confirm if, very simply, you're looking to sell during a downtrend on a pullback, and you're seeing weakness come in, maybe at a fib area, then a no demand. You can take that trade. You don't have to worry about 2 1 hour candles confirming. If it's there, that's good. But if you're going with the trend and you're waiting that long, you may just completely miss the good price and the good opportunity. So again, going at counter trend, we're giving it that time to really prove itself. So the situation here is that early no demand that may show up could be so early that the 1 hour chart did not confirm yet that you should be selling, right? Because you need a weakness on the 1 hour, and then you need the next one to not continue up, goes bearish. So as you're waiting for that confirmation to go against the trend, you may get that entry to go short. That's very aggressive. You really rather wait for that to set up properly in the 1 hour, those 2 candles. So that's my point about an early no demand, maybe just before you really get proper confirmation on a larger time frame. So it may just be too early to take that trade. Okay. Going with the trend, it's all good. So as we're waiting, again, maybe 90% of the time, almost every time, you're going to get an automatic support. You're going to get a little level of support that's going to, let me just get rid of this because we don't need all that in there. It doesn't have to be a fake breakout. So as we're waiting for our 1 hour, we're most likely going to find our automatic support, automatic rally in reverse. What has to happen to invalidate potential no supply? No, okay, yeah. Is it invalid as soon as the next candle would close above the no demand high? Yes, exactly. Yeah, I should have mentioned that too. So here's the potential no demand. So price can move above the high of a no demand, but if it closes above, it's canceled out. Again, if it moves below and ideally closes below, then there's your sell entry off no demand. Price can test up there, but as long as it doesn't close there, it's still valid. But if it closes above, we're talking about, is there a lack of demand, but then the next candle closes higher? There's obviously demand. There's more buying than selling. Price just moved up. Oh, my candle, my chart was frozen there. So there you go. Now you can see. So there's no demand. Price moving above it, that's fine, as long as it doesn't close above. And like you said, yeah, if it closes above, there's obviously more buying than selling. It sustained that and closed there, and that would cancel it out. Now, if a candle doesn't close above or below, those are neutral, as I call them, just neutral. So you could still get your confirmation. It may take a couple of small candles there, and then finally you get your close below. So yeah, close above no demand cancels it out. Close below the no supply when you're looking to buy cancels it out. Okay. So we are looking for our entry now, going counter trend. We're being patient because we're waiting for 1 hour to confirm in this situation. Or generally, even if you're maybe we didn't see a no demand yet, so we just didn't get an opportunity, or you're just giving it some time to confirm and give you a little more information, and you're not trading aggressively. So the point is you can get more information to help judge the probability if you're not so aggressive. So in this case, we have our automatic support here now. And we want to see that the volume on that, again, is not high, right? We want to make sure that really, ideally, the high volume is here. So automatic support, test for buyers. Okay, there's your first test. And we'll leave the volume there. So it's just sort of medium, and that's fine. Even a slight increase is fine. So it's all relative to the recent range and relative to the selling activity. So something like this says, okay, they're testing for buyers. There's a little activity. We get a little bounce. And that would communicate that there's, again, now we can use these tools and this 5-minute stuff to get information that's going to be valuable to tell us the probability. So this, for example, let's say if we have a little increase in volume off of that first level of support after weakness, automatic support, automatic rally in reverse. Let's say we have, for example, we'll go through different examples and what it tells us. Some higher volumes. Again, no problem because that's really the high volume. But some increase, we get a little bounce. That would communicate that there is some buying coming in and most likely is going to create a bounce there that smart money may or may not sell into. So again, we're just gathering information. We could take no demands at any point as long as we don't have anything bad happening. But just to run through it here. So this would suggest there's some buy activity. So if I saw this, I'd say, okay, it's most likely going to double top, or at least it's going to test this area, and we can find out if, maybe there's a pin area there to draw a box in particular to really see that very important area. But to see some active buying off of that first level of support after the weakness tells us it's typically there's still some active buying, and we get to see if smart money is going to continue to sell into the up move, and particularly in this area that they really were active and created that reversal. So that's, again, why you can often get double tops and often get fake breakouts, because it only makes it to here, and then there's more selling coming in. So again, just trying to get you in the mind of smart money. You're a smart money seller. You see a fair amount of buy activity on the test for buyers. You have the option of, first of all, you get the information that you're probably going to get good prices again because of the activity. And you have a choice if you want to continue to build up that short position or not. Typically, if they started to build it up, they'll continue. But in cases that they don't, we would see that the volume doesn't sustain high there. So that would tell us, where do those buyers go? And this is a good example, a good point to explain the concept that I basically had to come up with from observing charts, which is sustained versus temporary. So here's an example of this would be temporary because of this low volume here. So temporary selling, not a great situation. Initially, there was some selling here, but on the second test of that area, where's the activity? It's not there. So immediately, if I see this, I don't want to get short anymore. That's how bad that is. Now, in traditional VSA, they can look for no demand up here, which I think is a horrible idea. Because no demand is lower volume, right? Lower than previous two. It's generally a low volume signal. Now, if activity is low in the upper areas, particularly at resistance or in pin rejected areas, areas that we saw high volume selling, and price revisits that area and the activity is not there, it's just as likely to break out as it is to reverse, maybe even more likely. When you see breakouts of support resistance, notice that the volume is not going to be high. And again, it makes sense because the higher prices are not continuing to attract sellers, so that would be temporary selling at that price level, not sustained selling, continued selling over a period of time and building up positions. If we see them building up positions, that's the best thing we could see. Could you later go to AJ again in 5 minutes? There was a clear increase in higher prices. Okay, sure. Today's a little weird, but if at least we could get some sort of visual on things and see some sort of normal behavior, yeah. Okay, so everybody should understand this is temporary selling. It was not sustained over a period of time in this price area. Therefore, I would not look to take this trade. This could literally be one or two entities, large entities, that took some profit or sold. It doesn't necessarily say there's a consensus and there's confidence to build a position and really anticipating a particular direction coming. And smart money is just, selling the crap out of it in this area and creating a real resistance with generally increases in volume. Again, they don't have to always be really high, but increases, all we can do is compare with a recent range. We have low, medium, high, and ultra high, basically. So if this volume is high, great. If it's not, then they are not continuing to sell and really commit to building up short positions in that area. So that would be temporary selling. Now, this is particular to the way I traded. I discovered this through observation. One of the things I did, which I no longer do, and when I first started with volume, I was like everybody else. I read Master of the Markets 3 times. I still was confused when I opened the chart, whatever. But one of the things that I was doing was I would take low volume breakouts. I since found better situations to trade, and I don't really do that. But if it matches up with things that I do now, it doesn't hurt to see. It kind of also fits into like pushing through a resistance and not seeing high volume. But anyway, more likely to continue here because of the lack of sustained selling. Okay. So again, at any point you can take a no demand, but you may get information that may confirm or cancel out that. So, getting this extra information. Again, if there's a lot of buying here, I'm not just going to take a no demand now. So it should look more like that. Okay. So a proper top, if we're going to double top, is again sustained selling. What if we get a no supply no demand confirmed, situation goes in desired direction, and then temporarily change against it? Well, things normally don't move in a straight line. Unless I see a problem, an actual problem with the trade, I don't really worry about it because I know things just don't always go in a straight line. There could be tests along the way at additional obvious levels. But you're saying, is the no supply still important since it has been technically invalidated? I would say it's invalidated, unless you mean price went back beyond into the price area that we don't want. So you're saying you saw no demand, price starts moving down, but then price moves back above the no demand, is what you're saying. Yeah. Well, if it's starting to move up, the only, and that can happen, it could still be a good situation, is that, okay, there was some buying, but if price moves up again into the higher region, you're going to want to see sustained selling. And if it's not there, that's really what it comes down to. So you can have, multiple no demands as prices sort of ranging on the 5-minute. But it's really, what the continued information that you're getting to really tell you if things are okay or not. So, for example, let's say you got a no demand here. As it pulled away off the top and, that very first early aggressive entry, you get a no demand there, let's say. Whatever. So you get no demand, and then you're saying this, right? Price starts to move, but then we get above that, which technically above that cancels it out if we were talking about that technically there, but it moves above it, right? That can happen. That's totally normal, and it's not the worst thing in the world. The point is, as long as it's selling into these up moves, it's all good. It doesn't necessarily say there's a problem just because we moved above a no demand. Because again, there could have been maybe initial test for buyers very early, a lack of demand, but then maybe at another level found some buying. At that point, it may continue up, and you want to see them selling into the up move. Does that answer? Oh, perfect. Okay, good. Cool. Now, one thing to mention, because again, you can get so much information off of this. So, for example, let's say I took that no demand, really early aggressive. I didn't wait for automatic support. Obviously, this would have to be going with a trend if I did that. And I'm in no demand here. Let's say I'm up, 7 pips or something, and we're testing this level, and we're seeing all of a sudden buying coming in. I'll lock break even. I don't care. I got a bad situation, or potentially. But there's still a lot of buying left. And you probably see me do. I I did that in the Eurodollar trade. It almost got stopped out because I put my stop to break even so early, but it ended up working out. But you get the idea there. If there's trouble, if I go in early or whatever, if no demand, and that was the trade. I think it was just the first no demand, very simply, that showed up. And then you start to see, trouble. I have no problem just locking break even. So I want to be in a good setup if I have risk. So just to point that out, you can get this information. It can help you manage the trade. That's more rare, of course, that would happen, and I would do that. But just to give the example, trade what you're seeing, manage the trade according to what you're seeing. Okay, so here's a proper situation now. So this support set up without high volume. We have our high volume off the top. We do have a double top now. Again, sustained selling is being shown in this area. So once you see that, it's actually helped the probability. So also on stop losses, for example, if you're getting in before and it's going to end up doing a double top, it could go as far as a break and still could confirm. So a general rule on the stop loss is you want to put it in the area where the setup fails, not just a spot that could get hit and then go in your direction without you, and you get pissed off and rage quit. So we know fake breakouts happen a lot. You can pretty much find it every day somewhere. And so you don't want your stop right above a high. You don't want it 2 pips there. So generally 5 to 10 pips to give a room for a fake breakout. Again, I learned that the hard way. And I'm like, I came to a point where I said, so many trades would have been winners if I just gave it that room for a fake breakout. So I now do that no matter what, unless it's a large pip amount. And then I'll try to do something a little differently and go with a fib or something. So just keep that in mind. That's the general rule with stop losses. There's a price area where really the setup starts to fail, and that's where you want to get out. Ideally, that's 20 to 30 pips away. That's it. So even after this situation, you can get a no demand again. Very common stuff here. Now, this no demand would be better probability than this one because we've seen automatic support, not a lot of buyers. We've seen that there's sustained selling. So that's a better probability than that one, even though it's the same thing. Same price area, no demand. Better probability because we have this information. You'd also say if this was a 1 hour reversal situation where we'd have to wait out the 2 candles, that maybe by now we'd have our confirmation. We have our bullish candle with a bearish reaction on the 1 hour chart. So that could also, of course, be the point at which you can now look to enter. Going counter trend. So that extra information on the 5-minute is very helpful. And again, those early no demand, no supplies on very clean setups that are not counter trend, like a very simple fib pullback and stopping volume at 618 fib, and then followed by no supply with no demand. So we have that. Now, this is still our automatic support going forward at a very important level, and can give us our next entry. You want to look at AJ 5-minute now? Sure, let's see. And then we'll come back to this. So the rest of the entries. Let's apply this to the AJ 5-minute, even though it's a wacky day. But let's just apply it and get that information. Okay, so trying to move this menu out of the way that you don't see. Okay. So again, volume wasn't quite right there. We need high volume of the high price, not this aggressive buying news crap. But anyway, if we're seeing this upper area tested without higher volume rejections, that is not what we want. It's going to tend to continue. So are we seeing that? Actually, we are. I normally don't look at the 1 minute, but it's kind of a small thing here. Yeah, see how that's the higher price? It's so slight, but that's the higher price. That's the highest price at that point in time. And then look at the volume for that 5-minute candle, right? So that is showing sustained selling into up moves, again, there. And ideally, that would be the highest volume, not this stuff. And we're not dealing with the ECB press conference craziness. So again, this does confirm the situation. So we're kind of taking it out of context. This is a 1 hour that didn't quite confirm with a bearish reaction, although it didn't close above, so it didn't cancel it out. So if I'm seeing this ultra high volume, I am looking at the 5-minute here and giving it that time. It is counter trend. And if it's going to continue to test these areas, there's no rush. I don't have to sell up here and get that perfect price. I can find out if there's sustained selling or not. At any point, if it moves through here without high volume and starts to move up and break, there's no trade. But as long as it continues to reject on higher volume, it's telling you your probability is good, getting better and better because they're committing to really building up those positions. Now, as far as automatic support, this isn't a clear example here, but technically, again, we're assuming that the volume is the highest here and not these two, so we can even use this as an example because this is not quite right. So we want this to be the high volume. So, pretending that's the high volume there and not these two, then this would technically be the first area of support, the first level of support after weakness would be there, right? Typically, it comes a little later, and it's more of a cleaner looking support. But if we just go by that, if there's weakness, price comes down, and then it bounces, we have our automatic support now. So I would draw it there, first level of support after weakness. And again, we're seeing some higher prices now. And everybody should know what we would want to see if we were going to continue to consider a short. Higher volume and rejecting. And again, these points just need to be higher than the recent range, not just not climactic. And that's what they are. We'll see how that one closes, but it's getting up there. So again, we don't have to short up here, but we get that information. Are they continuing to sell? And, again, if it pulls back, you look for a no demand entry. Any other questions on this? And I'll go back to my artwork. Okay, cool. David. Okay, good. Back to paint. So let's just run through them here. Additional entries. The rest of the entry opportunities. Now, we'll talk about no demand and another no demand. And in this case, we're seeing a no demand at the automatic support. So you can imagine like the AJ where I drew that support. So again, it's a test for buyers, right? That's an area where they are testing for buyers. That's why it's set up. So again, low volume test, no demand. Now very often you get a no demand here leading to a break, which is an entry, of course, just because it's a no demand, but also to see it at a level. Again, I don't think you'll find this concept anywhere else, that they're going to test for buyers or test for sellers in obvious areas. And it just really cleans it up and makes a lot of sense. So in this case, we see the pushing through of the automatic support here off of a lack of buy activity. So now we've really pinpointed at this point in the pattern the imbalance of supply and demand. There's a lot of supply, a lot of selling, and lack of buying. And now prices moved below the range, out of the range, and below the automatic support, which tells us they're attempting the trending move at that point. This is the point at which it should trend downward. Go to the next support, whatever, right? Move down until it runs into some buying at lower prices, right? But that could be a good distance away at that point because we have that real imbalance being shown. So that's a no demand at automatic support. Of course, automatic rally, you can get your no supply if that's an automatic rally, and you move up and you get your little no supply test there, and then you end up through it, and there's your entry. So that's always nice to see, the combination of pushing through, if there was strength off the bottom, pushing through off of a lack of selling there. Makes perfect sense. You understand exactly why that happened and what you expect now, why you expect it to trend. Again, thinking like smart money, understanding them. They built up these short positions, and this is telling them two things. They're not going to get the higher prices anymore to build up because there's such lack of buying, and that they can now mark down price without dealing with buyers coming in. It's going to cost less as they can enter the market in such a way to intentionally mark down price. Big difference. They're hiding it there. It's still an uptrend. It's at high prices, and they're waiting for those buyers to dry up. When those buyers dry up, they have the green light, the imbalance. So they're not picking a fight. They're not trying to fight the market. They're not trying to fight the herd. They're just staying a step ahead of them, basically. And whoever bought to bring it up here, smart money's selling to them. It could have been good news that caused price to move up. Whatever it is, that there's some buying, and those people are, smart money is staying a step ahead and selling. So again, the buying dries up, and that gives them the green light there. They don't want to fight it. They want just to really take advantage of it. So let's continue with the entries. So again, it's very simple, no demand, but in this case, it pushed through and really marks a switch over to distribution into markdown. Okay, so another entry would be simply pushing through this level without a no demand. And there's your entry. And I call this the push through automatic support. So the push, it's the short name, is an entry. Now, there's a particular, and you can understand why, right? There's no buyers here. The sellers are positioned in the area at which they were testing. And basically, you're pushing through the automatic support. So the requirement to enter here on this candle, 5-minute chart, is that the volume can't be excessively high, and the candle needs to close at or near the low. Why? Because that saves us from what if lower prices are attracting buyers? What if there's still balance? What if there's not a clear consensus among smart money? We just made lower prices from this range. So if we see high volume there, high volume into lower ground, it can be buyers coming in, right? Lower prices can attract buyers. If the volume is high, most likely that's buying coming in, unless, of course, it just starts to drop really fast off the high volume. But lower prices attracting high volume, okay, it could be some buying coming in. Also, if the candle closes off the low with a big pin, something like that, along with some higher volumes here, that tells you don't want to take that. So what do you want it to look like? Closing at or near the low without high volume. Slight increase is okay. It doesn't have to be a no demand, lower than previous two or anything. You just don't want high volume there, right? Because lower price is high volume. Bad. So medium volume, that's fine. And seeing this candle close at or near the low. So no large pin on the bottom. The only way that could form is if lower prices attracted buyers and it started to bounce up during that candle and it closed with a pin. So we really want to see that the buying is inactive. So closing at or near the low of the candle without excessively high volume. I'd even allow it to go maybe that far. We're comparing it to really this stuff. And it can't be anywhere near this. We don't want that. That's about as far as I'd let it go in this picture. Okay, so that's valid entry there. Next one. Very common pattern. Very, very common. Learn it. Memorize it. Know it when you see it. Break test continuation of automatic support. Low volume test. And it could be by definition a no demand. So for example, if I'm still waiting for the 1 hour confirmation on a reversal, I can wait for that. If volume was a little on the high side here and I didn't take the trade, I can still see this low volume test and a no demand there. It gives me some more confidence. So again, as you go, you get less and less aggressive because you get more information to tell you how good it's looking. So we have all this time because, again, this is a 5-minute chart, and we're either looking to reverse the trend or we're looking to go with the trend off pullbacks. So we still have plenty of room here if we're looking at a small time frame and we're looking to short now. But that's typically the last place I'm going to look to get in. So now on this break test continuation of automatic support, you could by definition get a no demand there, right? Volume lower than previous two on that test, closes below and you get your entry. There are times when you'll generally just see a low volume test here, but you won't get by definition exactly a no demand. So just to point that out, it's okay to use common sense and say, okay, it's a low volume test. Let's say, for example, it looks like this. Right? So it's low volume compared to the recent range. But by definition, you don't have a no demand in there. You don't have one lower than the previous two kind of thing, right? You don't have that technical no demand. But generally, a low volume test is what you're looking for there. So it's still valid to me if I don't get technically that lower than previous two thing, but just a low volume test. You don't when you see it, the volume is low on that up move. Now, if we're talking about a 5-minute chart and you see this, switch to the 15-minute chart because you may see that it's a no demand on the 15-minute. It just kind of sums up this move within one candle. Maybe it's 3 5-minute candles moving up, and a 15-minute will be one candle, and it'll have volume lower than previous two. Generally, the 15-minute is nice. Like if the 5-minute is just going slow, and you can go to the 15-minute, and it just suddenly cleans up. So whether it's a no demand or not, the low volume test of the automatic support after the break. So it's a break test continuation pattern. And they're testing for that level one last time, testing for buyers one last time before they really, again, are pushing it down and aggressively marking it down at that point. And that's that same level. So a very common pattern there. So, like I said, this is a 5-minute chart, but the stuff that we just did, imagine now you're looking at this and it's a 1-hour chart. It's the same concepts. Same thing, automatic rally, automatic support, the high volume in certain places, low volume in certain places. If I open my 1-hour chart and I see this, I'll say, okay, today I'm looking for shorts. If you're on a 1-hour chart and you're anywhere in this overall pattern, maybe you have the double top. Maybe you just have a single top on ultra high volume and an automatic support. And price is moving up, and you can see how it behaves up there. You can see if it pushes through and how it behaves when it attempts to go into the markdown. So it's all the same stuff. So your overview and then your detailed view. So once you really learn these patterns, you'll see how often they pop up fractally. And it's all because of those two principles, that higher prices attract sellers, they may or may not, lower prices attract buyers, and the test. Then you get previous support, term resistance, fibs. Pretty much sums it up. So that's going to create these types of patterns, whether you're looking at 1 hour, or 5 minute. So no demand or low volume test there, and you can get your short entry. And of course, we had that initial push through entry. Then we got our no demands in here, entry. Just to point out, just to mention, I used to take, or at times, if I was going to be a little more aggressive, after the fake break and we close back into range, to short there. Because we've already had a double top. We've already seen, we've gotten a good amount of information. Selling, not a lot of buying there. Double top, fake break, coming back into range off high volume again, and then selling at that point. I don't really do that much anymore, but you can see the logic behind that, of course. It's much more likely to move down. It's a good risk reward. You can get a small stop. You may even be up, 17 pips when you get here and you take first target because you got in so high. But, it's a little more aggressive because you're not, again, waiting for a no demand, which always helps. But just to point that out, I don't really do that anymore. I tend to really wait for no demand, no supplies. Got to have that test or else you really don't know what you're dealing with. But that's particularly off, fake breakout. It's reasonable. If I have a lot of things telling me to take that trade, maybe there's a few areas of, confluence right here. Could be a previous this, that, and the other. So, as far as, how aggressive you want to be, it really depends on the overall setup, If there's 4 or 5 things telling me to get into a trade, which does happen sometimes, I'll tend to get in a little earlier. If there's 1 or 2 things telling me to get in, I'll be more patient as far as volume combined with the other tools we use. Okay, so we have our entries there. And at this point, there could be multiple no demand entries on the way down. Volume lower than previous 2, and simply testing for buyers on the way down. So you can get a no demand there, move below the low, entry. No demand, move below low, or close below, entry. That pretty much sums it up. After a while, I don't like to chase the move. So really, this would be like the latest I would want to get in, would be here. And that's even rare. Like at that point, I'm already going to want to be in. Because things zigzag. Lower prices may attract buyers. We don't know what's up. The lower it goes, the less chance our trade is going to play out for us, and we don't know what's lurking down there as far as buyers that may come in, right? The lower it goes, the more imbalanced this is now becoming again, finding buyers. So that pretty much covers it as far as the 5-minute entries. So the idea is, again, this should be pretty simple and straightforward here, what we just looked at. We have pretty much black and white rules for everything. If price does this, we need to see that. If price moves up to the high, we need to see high volume. If automatic rally sets up, automatic support, we need to not see it set up on high volume. If we get through this level and push through into new low ground, we don't want to see buyers coming in on high volume. It's all black and white. When you get into real world, you may struggle a bit to read it, but I don't see where I really leave any room for any misinterpretation. I think it's pretty straightforward. And keeping in mind, the context, this is the 5-minute chart that you're properly, looking right on the 1 hour. Okay, so let's see, what time is it here? Oh, it's already 10:40. That was fast. Okay, so I'll be back in 2 minutes. See if you have any questions. We can take a last look at the charts, even though it's a shitty day. And maybe just try to apply this. I know it's really a bad day for this, but so we'll finish it off. I'll be back in 2 minutes. Oh, sorry, one more second here. Is So again, we talked about all our entry points. At this point, it gets a little late. I don't like to chase it at that point, even on a no demand. And what I would look for is very simply see how the lower prices are behaving, as far as are they attracting buyers or not. So, good stuff. You don't want to see high volume, of course. You don't want to see stopping volume and strength coming in and then go short. So, if you saw something like that, I'm not going to go take a no demand entry. I'm not doing that. So you just want to make sure that, again, it looks like a healthy trend if you're going to be taking those no demands. But ideally, I don't want to get in too late. And if I'm not seeing large strength coming in, a little bit of buying, to cause a retracement is acceptable. And again, going with our 1 hour overview, seeing where we are. But, at that point, I'd look for fib retracements. So I can draw a fib from that high to that low now that it's retracing. And of course, maybe you get a fib zone right there and see selling coming in again. So redistribution, weakness again. And then you can actually do this again. But, if we're talking about going with the trend, it could be a very simple weakness, no demand entry. But that's that thing again. So again, if it's too late, but we still haven't seen large buying, so I want to get with the trend, but it's already moved a good amount. Looking for the retracement. It doesn't have to be fib, it just very commonly is. But it could be a previous support to resistance and a pivot, Coming back to test a level, finding that those sellers coming in again at the high price, and looking for your entry. All right. So maybe one last quick look at the charts, if anybody wants to see anything. Let's see what happened on the AJ. Again, it's not ideal, but we're just kind of using this as an example. Higher prices. Where's the high volume? It's not there. Slight increase. Pretty much we could say that's medium volume, right? Obviously, compared to the recent range, we would say that's medium volume. We want to see, of course, the higher the better. So that's not so good. And secondly, now that we broke out, we would want that to close back into range and confirm that it's a fake breakout. So ideally, if we were looking to short, we need price to get back below there, like I said, right? Confirm the fake breakout, whether it's a 5-minute or a 1 hour, because that acts as support and it can continue. So that helps your probability a lot. And the higher the better on the volume there, and it's not even high really. So that's not a proper situation here. So again, I'm never looking to get in at the absolute high price. I use that to give me information. And then, if that's ultra high, or if that's nice high volume, at least, something up here, and it comes back and confirms that it's a fake breakout, okay, then I look for my no demand, Okay. Seems like everybody's good. No questions. Again, today is just kind of crappy anyway, so I have no problem not taking a trade, and there's probably not a lot of good examples to really show anything. Obviously, if this candle in 10 minutes closes above the high of the potential weakness, from a 1 hour point of view, first of all, that would tell us it's not a proper ending to a trend. It closed higher than the climactic. And by closing above, it completely cancels out the short opportunity. So in 10 minutes, it could, of course, get squashed down and not. So that's the first piece of information, and then we can go to the 5-minute and see what that tells us. Are the higher prices attracting sellers? No. They are not. So even if that closes down, our 5-minute says no good. But very simply, this would change everything. High price, if the volume was up there, much better situation. So we see in this case, crappy day, but we see in this case, it is not telling us to go short. So if this was an uptrend we're looking to get into, we want pullbacks and strength to come in. If we're looking to short, 5-minute has to agree. Higher volume at the high price. All right, I think we covered a good amount of stuff. And, before you do all this stuff, we basically started with the 1 hour, but, as I do, you want to start with your larger time frames. Just mark obvious support resistance areas. This could have been a level to consider a short if it was moving up here, because I'm not taking a breakout trade, and I'm not going to buy into a resistance. So it would be an opportunity to consider a short, and it could even be a fake breakout. There's the resistance there, pops through, and if we saw proper weakness 1 hour and 5-minute, it would be all coming together, right? But we wouldn't really know that unless we went to the larger time frame. This goes back to February 18th. So a fake breakout there on high volume would have been a good start, but we're just not seeing it. So it's more likely to continue through this resistance level, even though it's pulling back here, because the volume is telling us it's not active selling. And things tend to continue until the active selling comes in. All right, I think we're done for today. We made the best of it. Not a good day to trade, so hopefully the newer guys are learned a few things and open up your charts tomorrow or whenever you trade again and apply this stuff, see how you do, see if I have any questions. All right. Cool. Very welcome. Okay, guys, have a good weekend. I'll see you on Tuesday. And it was a really tough week. I ended up with small profit. 1 win, 1 loss. The AU was a small position. The EU was like half position. So I didn't make a lot. But, you look back on this week, and it was tough. And there was a lot of uncertainty and, the choppy range and the spiky stuff. But then today, to finally move out of it, it should be, a good sign for next week that we can now trend again and start to do regular stuff, hopefully. But we'll take it as it comes. But it always comes back. Cool. Everybody liked it. Good stuff. All right, guys. Have a good one. See you Tuesday.